Okay, welcome to another operations research video. So this one we'll be talking about portfolio selection, looking at some stock data. The goals of this video are to introduce a little bit of quadratic programming, as well as introduce you working directly with ROI to build these quadratic programs. So up to this point, for linear programming, we've used OMPR, which sits on top of ROI. For this video, I'm going to show you how to work directly with the ROI library. Okay, and we'll have an additional plugin that we'll need, QuadProg, to deal with the quadratic programming problems. Also, to get the stock data, we're going to use this QuantMod package to download the stock ticker data. So first off, let's collect some data and kind of the goal of the code that we're building is to build a portfolio of stocks that has the best combination of both risk and reward. And so this was kind of inspired by the case study that's linked here. And this case study has a lot more details in it. And so I encourage you check it out and go look at it. So let's collect some financial data. For this tutorial, I focused on the 30 stocks that are in the Dow Jones Industrial Average as of January 2025. And so these are the tickers for those stocks. If you run this code here, it will go ahead and download the price data for those stocks. And then what we're going to do with that price data is we're going to look at the log difference in prices between days. Also, we're using the adjusted closing price for each stock, which adjusts for if the stock splits or gives out dividends. It sort of takes into account that value from the stock as well. So yeah, this code will do that. And then we're looking at the difference in log price. And the reason why is that if you look at difference in log prices, then things work nice additively. And that if you take a bunch of an average of logs or a sum of logs, that sort of converts inside the log as multiplication, which is what you want when you're thinking of exponential growth. So yeah, difference of logs is nice when you're working with things that grow exponentially. So let's take a look at just a few of the stocks. I picked out 3 of the 30, NVIDIA, Nike, and JP Morgan. And here I'm using some code using dplyr and ggplot, which are from the tidyverse package. You can kind of look at what I'm doing, but don't worry too much about it. And so here are those 3 stocks over time. These are the log difference in prices. And so anything above 0 would be a daily gain. Anything below 0 would be a daily loss or reduction in value. And you can see, so this end is about a year ago. So it's a year's worth of data. So this end is a year ago. Here you can see, I think this is NVIDIA had a really good day. About half a year ago, Nike had a really, really bad day. And then what was funny is I built this a couple days ago, but I wrote it so that it would always take the last 35 days from the current date. And so yesterday, some news came out and NVIDIA had a really, really bad day. So it's interesting now as I'm looking at it to see what's changed in the results because of NVIDIA's very bad day yesterday. So yeah, so that's some difference. Main thing, just like anytime we're looking at financial data, is you can see there's a lot of variation and volatility in stock prices and them going up and down. So these aren't looking directly at the prices, but rather at the price differences. And so yeah, be aware of that. Okay. Yeah, and we can look at the average returns by essentially taking the average of the column corresponding to each of those. Maybe actually it'd be worthwhile to look at this DJIA, Dow Jones Industrial Average object that I created. These are all those log price differences. I've got a column for each stock, And then you can notice each row is a different date, going from January 30th of last year, all the way down to January 27th of this year. So, and if you know a little bit about stock tickers, you can kind of decipher which one's which. I had to look up most of them, unless they're super obvious ones like IBM. And so here we can see NVIDIA had an average daily return of about 0.25%. That's kind of strange thinking about it in daily returns. And so if you want to kind of convert these into yearly returns, there's about 250 trading days a year. And so you can multiply these by 250 to get what the yearly return was for that each stock. And so NVIDIA was up, Nike was down on the year, JP Morgan was up, but not as much as NVIDIA. So even with NVIDIA's last bad day yesterday, it's still better than either of the other two stocks. And then what I've got here is a portion of the covariance matrix, and this will come up a little bit more later. This covariance matrix along the diagonal, when we look at NVIDIA versus NVIDIA, it tells us how much volatility or how much variation there is in NVIDIA's price. And so here's the amount of variation in NVIDIA's price, Nike's price, and JP Morgan's price. And so you can see that NVIDIA's had a lot of swings both ways, big ups and big downs. It's had a lot of volatility. Its variance is over twice as much as Nike's, and Nike's is about twice as much as JP Morgan. And so JP Morgan has had small fluctuations over the past year. Nike's had a little bit larger. NVIDIA's had pretty large variations over the last year. And then if we look at the off diagonals, this is looking at NVIDIA versus Nike. This is how much the two stocks are related to each other. And so if it's a negative, then as one goes up, the other tends to go down. If it's positive, then as one goes up, the other tends to go up. The closer it is to zero, the less related they are. The higher it is, either positive or negative, the more related they are. And so it looks like JP Morgan and NVIDIA have some positive covariance or correlation, and it's a stronger relationship than Nike with JP Morgan. Interestingly, Nike tends to go down slightly when NVIDIA goes up. And that's maybe just because Nike's had a bad year this year and NVIDIA's had a good year this year. You might not find these to be particularly robust if you were to look at these over a longer time window. Okay. But a year's worth of returns is enough for us to play with without the data getting too big and the programs getting too long to run. So our first model, let's just try to maximize the return. Okay, and so we're going to maximize the amount of return subject to we've got a budget of money that we want to invest. Okay, and we could make the budget $1,000 or $1 million, but what's actually pretty common is just set the budget to 1. And by doing that, we kind of think of 1 as our budget, and then we can interpret our decision variables as, instead of being dollars invested, as being proportions of our budget. Okay, and by setting our budget to 1, and then we'll have a constraint. Here's our decision variables, X, some S. Those are how much we invest in each stock. And so if all the sum of all the stocks add up to 1, we can think of it as our decision variables as being the proportion of our budget that we're investing in stock S. Okay. These mu S's are going to be the average daily returns of that stock. And so if we want to maximize our expected value, we just maximize the sum of the averages, the average of that stock times our decision variable, which tells us how much we're investing in that stock. Okay. I'll say we also have non-negativity constraints here because we can't, in this model, invest negative amounts in a stock. So it's just, we're just buying stock. We're not thinking about reducing or selling stock or shorting or anything else like that. We're just buying stock and then thinking about what we'd expect for our returns a year in the future. Okay. And we're basing this off of this last year's data. So kind of anytime you're investing, notice that remember past performance is not guarantees of future performance, but we can get some statistical averages and some expectations of what we might expect. Okay. So this is our basic model, and we want to maximize our expected returns. So first thing we need to do is compute this vector of mu's, which are the column means of each stock. So the average value of each stock or average returns for each stock. And just looking at it, NVIDIA's bad day yesterday. Before it, NVIDIA was the #1 best stock in this list of stocks. Its really bad day only knocked it down to #2. And so I think it was before it was 0.0035 and was quite a bit better than everything else. Now, after its bad day, it's now only 0.0025. And it looks like 3M has taken the top spot. Okay. And the reason I chose Nike is Nike has had the worst year of all the stocks. And yeah, and JP Morgan is one of the better stocks on the list. So I kind of just chose 3 stocks to look at. So let's go ahead and build the model in ROI. And so what I encourage you to do is look through a little bit of the help for ROI. But the main way that we build an optimization problem is with this OP function. That's how we build our optimization function. And the things that we put into that optimization function are an objective, constraints, types of variables. They default to be continuous variables, but if we want to change the type of variable, we can change that. Bounds on our constraints. So if we wanted to change lower and upper bounds, the default is lower bound at 0, upper bound at infinity. And so it sort of automatically puts non-negativity constraints in there. And then when we're setting our objective, there's different choices on functions that we can use to build our objective. So if we want a linear objective, we use L_objective. If we want a quadratic objective that we'll meet later on, we'll use Q_objective. Same thing with constraints. There's a bunch of helper functions that help you build your constraints. And then so in this case, we're building a linear constraint. Okay. I encourage you to look at the help files for L_objective and L_constraint. But in essence, for a linear objective, you need a vector of coefficients. And in this case, our vector of coefficients is going to be the mu vector of these average returns. We can also provide names at this point when we do our objective function. And that will give us essentially set the names of our decision variables. And so we're going to keep our decision variables named with each of the stocks names that are also in that mu vector. For our linear constraint, we need to give it a vector, or actually we can give it a matrix, but in this case, we only got one constraint, so one row, a one-row matrix. And that one-row matrix, if we think about this constraint, just has 1 in front of each of these xs's. And so we just need a matrix that's 1 row and is made up of all 1s, and it should have number of entries or number of columns equal to the number of stocks that we have. And so that's what I've done here is I've used rep to repeat a bunch of 1s, and I'm going to repeat it once for every stock. Okay, and that will give us a coefficient of 1 in front of each of these xs's. And then we set it to our direction is going to be an equality constraint, and our right-hand side is going to be 1. And so this sets up that budget constraint there for us. Okay, so once we do that, now we're ready to solve the model. And ROI is a general interface. It doesn't do the solving directly, but it passes our problem that we build in ROI onto a solver. And so we can ask ROI, what are the applicable solvers that would work for this? And it will give you a list of solvers that you have installed and would work for that problem. Okay. And so, or would work well for that problem. And so, yeah, depending on which solvers you have installed, you might see different options here. Note we can just install other solvers in general by just installing their plugins. Some solvers have more involved process to solve them or to install them. So in this case, we'll use GLPK. We've used that a lot for linear programs. This is a linear program because we've got a linear objective and linear constraints, or one linear constraint. So to solve it, we use ROI solve. We give it our model and we tell it which solver we want to use, and it should come from the list of one of the applicable solvers that we have. Now let's look at our solution. Pretty similar to how we accessed our solution before when dealing with OMPR, is if we just type in this, it will tell us the status, which is optimal solution found, and tell us the objective value, which in this case is 2.67 times 10 to the negative 3. And then if we put a $ solution on the end, it will give us the actual values of our decision variables in the optimal solution. And interestingly enough, if we want to maximize return, it puts all of our budget in the best stock, which happens to be 3M. So if you want to maximize your return, you put all your money in the one best stock, right? Yeah, and that's what happens if you ignore risk. So that maybe leads us into a second model, which is we want to take risk into account, right? We don't want to put all our money in one stock because we don't expect it to necessarily be the best stock next year, okay? And so let's build a next model. And for this one, we're going to want to look at the variance of the portfolio. Okay, and we can compute the variance of the portfolio by this quadratic function here. The sigma ij's are the covariance entries in the covariance matrix. They tell us how related stocks are to each other, as well as if it's sigma 1, 1, or when both of the kind of along the main diagonal of that matrix, it tells us how much variation that stock itself has. Okay, and so for our decision variables, we take our decision variables times this matrix and then times our decision variables again. And then we're summing over both I and j there. And so in the end, we just get a number out. Okay, and so you could write this equivalently as X transpose times the sigma matrix times X again. Okay. Yeah, and I've got a little bit of details about covariance, and I encourage you, go ask a finance professor if you want to know more. I know the math side of it, and I've read enough of the finance side of it that, yeah, this makes sense as something that we might want to use as a measure of the risk associated with a portfolio. Now, if you go back to that case study or tutorial that I pointed out at the very beginning, it's got a lot of other very interesting measures of risk, and you could definitely experiment with some of those. Okay. This is going to be a quadratic function, and so this is going to bring us into quadratic programming if we use this as our objective function, which is what we're going to do. So let's first off get that sigma matrix. That's going to be the covariance matrix of our daily returns. And so COV in R will compute that covariance matrix. And if you want to, here, let me click on that and show you what it looks like. And so this covariance matrix sort of shows the relationship between each of the stocks with each other, as well as how much variation there is in each stock by itself. And so when we look at AXP and AXP, this tells us how much that AXP stock varies from day to day. Okay, and the idea is that if we choose stocks that don't vary at all, like if you could guarantee me that I'm going to get 1% over this next year, that might be better than having on average 2%, but a lot of variation so that it might be anywhere between plus 8% or minus 4%, right? So there's maybe some trade-off between how much we want in our expected value of what we want versus how much variation there is. And I'll look at that a little bit at the very end too. So this first model that we're going to build just minimizes the risk, okay, by minimizing that variance function. So our objective, we take 2 times that sigma, and what I'll point out here is that if you look at the help file for Q objective, it's got a 1/2 baked into it. And so to account for that 1/2 that it's going to multiply by, we double it here. Now, truly, if we minimize half the variance, it would give us the same optimal solution, but it would give us a different objective value that would be half as much. And so yeah, just be careful about reading help files whenever you're doing any sort of coding, and make sure that it's expecting its inputs in the same format that you're giving them in. Okay. So for this Q objective, you give it the matrix that forms essentially the middle of an X transpose matrix times X. And then you can give it the names of the columns. You could also give it a linear part as well if you had a objective that had both a quadratic and a linear term in it. In this case, it's sort of purely quadratic when we're minimizing variance. And then again, we're going to have the same linear constraint on our budget, that we want our budget to be exactly equal to 1. And then when we look at applicable solvers, it's giving a lot fewer options because the linear solvers won't work because we've got a quadratic objective, okay? And so we're going to use quadprog. If you're not seeing quadprog here, make sure that you've installed the quadprog plugin for ROI, which is exactly the library that I have listed at the top of this R Markdown file, okay? So now we've got our solver. We can go ahead and solve. We'll solve it with that quadprog. And let's look at that solution. So it found an optimal solution. The objective value is this. Not a lot of meaning to this variance. Or if we take the square root of this variance, that's actually going to give us our standard deviation of our portfolio, which I'll talk about in a little bit. But what you'll notice now is if I look at my optimal solution, the budget is a lot more spread out. I've spread it out amongst a whole bunch of different stocks to balance my risk. Okay. Instead of putting everything into 3M, I actually don't put anything into 3M anymore. But instead, I've invested in maybe a bunch of stocks that are very not strongly related with each other, and each individually have relatively low variance. Okay. And yeah, so that's the idea. If you want to minimize risk, you spread your money out. Okay. But notice that the expected value for this solution is 0.00055. Okay, so kind of, I think it was previously it was 0.0025. And so this is only about 20% of as good of return as what we had before. Okay, so we gave up a lot of sort of expected returns or reward in order to reduce our risk. Okay. But if we compare this risk, which is 2.5 times 10 to the negative fifth, to the risk when we put it all in 3M, we've reduced our risk from 3.6 times 10 to the negative 4 to 2.5 times 10 to the negative fifth. So probably about over 10 times less risk than before. Okay. So there's always going to be a trade-off between risk and reward, between the variance of our returns and the expected value of our returns. And if we optimize for one metric, we don't expect the other metric to do very well. Okay. So just kind of, here's a basic table of our two strategies. If we try to maximize return, this is our expected return, and this is our expected variance. We see we get a higher variance and a higher return. If we try to minimize variance, we get a lower return, but a lower variance. So less reward, but also less risk. So a common strategy when we face this sort of trade-off is to create a target for one quantity while trying to minimize or maximize the other quantity. Okay. And because it's easier to have linear constraints and a quadratic objective, we're going to try to minimize risk while giving ourselves our target for what we want for the expected return. Okay. And we'll sort of move that target progressively we'll start off at this as our kind of lower end target, and we'll move it up to our best possible target. We know we can't do better than that value when we try to maximize return. And we'll sort of move that across, and that will give us what's maybe called an efficient frontier of the possible trade-offs between risk and reward. Okay. So the way I've set this up is I've made some return targets that go from just above this value as the kind of starting point at the lower end of what I might use as my target for return, up to just under this value for my upper end of what I could use for my target as return. And I've made 10 targets. Okay, so we'll solve the problem 10 different times, each time with a different target for what I want for my expected return. Okay, so all this is then a for loop. For loop allows you to repeat code many times. And so I'm going to repeat the code inside from the for loop to the closing curly brace. I'm going to repeat it 10 times. Each time I'm going to use a different target on my right-hand side. Okay. Notice now I've got the same objective as when I was minimizing risk, but now I've got two constraints. One is my budget constraint where I've got all ones. The other constraint, I'm using that mu vector to make a constraint on the expected value of returns. Okay, and the budget constraint is an equality constraint. The expected returns, I want to do greater than or equal to whatever my target is. I want to do at least as good as whatever my target is as far as expected returns. It'll run through this, and then I've got it storing everything into this results table. Okay, so here's that results table. Here's kind of my first target, which is essentially the same as this. And then I get essentially the same variance as before. Excuse me. And then each time I up my target for my expected return, and as I increase that target, the variance also increases as well. So as I raise the target for what I want as reward, the risk goes up as well. Rather than looking at numbers, let's look at this visually. And so here's a plot. Let me kind of zoom out just, or maybe here, let's put it on a separate, let's pop it out there. Okay, so here is the expected return. These are essentially the targets that I was varying across the x-axis. And so I started here and there's sort of low variance. As I move my target up, we notice that the variance increases. There's sort of a point right here where it jumps up a lot at the very end. And so looking at this kind of curve here, I might want to set my target at maybe just something a little bit less than maybe this is 0.20 or 0.002, 0.0025. So maybe 0.0023 or 24 gets me pretty good returns while keeping my variance relatively low. Okay. So, but just sort of moving from left to right here increases my reward, but moving up and down here or moving up here increases my risk. So I can get high returns, but I have to accept high risk at that point. Okay. Because we have both expected value and variance, variance is the square of standard deviation. We can square root that variance and get a standard deviation, and then we can build a confidence interval. And so if you've had a little bit of stats, we can kind of think of plus or minus 2 standard deviations should give us a 95% confidence interval where we'd expect our returns to be most of the time. And so here I've just added on a lower bound and an upper bound for this confidence interval where I'm subtracting 2 standard deviations and adding 2 standard deviations. And I'll show you what that sort of looks like here. So here across the x-axis, I'm still varying my kind of target return. And you'll notice that as I change that, here's actually the target return kind of going up. The expected value increases here. But then the standard deviation is that green sort of ribbon around it. And what we notice is that no matter where I'm at along here, this return distribution goes quite a ways positive to quite a ways negative. And so even if I choose at the low end and kind of minimize my variance, I'm still it's still plausible that I get anywhere between plus or minus 1% for my average daily returns, right? And so the expected value like is pretty small relative to sort of the range that's reasonable or plausible for what could happen as an outcome. Okay, and so even if I kind of choose maybe a medium target of 0.002, which is 0.2% return, it's plausible that I get as much as about, I'm guessing that's about plus positive 1.8% return all the way down to a negative 1.4% return. And so there's a large range in what could happen even when I choose something that has a positive expected value. There's still a lot of uncertainty. Okay. Which is why you should always be cautious when investing and also keep in mind that the time window of this was daily returns, right? Lots of things can happen in daily returns, and yeah, that's one reason why I don't follow the stock market too closely, because I know from day to day it goes up and down, and your best strategy is to hold things to where those ups and downs will eventually balance out. Okay. There are a bunch of other variations on how you can choose portfolios, and so I'll kind of point you back to that case study again to end it here. Yeah, it's pretty interesting in the different metrics that you could use as your objective that might measure both risk and reward, as well as what constraints you could have in there as well. And so, yeah, that will wrap up this portfolio selection example of quadratic programming. I encourage you to run through the code, experiment with it, especially pay attention to how the optimization problems were being built using ROI. Okay, so that's it for this video.